Hello, everybody. Thank you for being here. It's our investor breakfast, which we host every 2 weeks. And I'm Bonnie Halper. I write the weekly Startup One Stop newsletter. I'll put the link in the chat, which has a little editorial and a lot of helpful links for entrepreneurs. And every 2 weeks, we host a breakfast with one investor and a small self-selecting group of entrepreneurs so that everybody can participate. And we want to thank Work2 for hosting us. So Christina, tell us about Work2.
Good morning. My name is Christine Heinrich. I'm the Director of Customer Success with Work2. Work2 partners with hotels and restaurants across the nation to provide people with safe working spaces.
And this week we are once again having Thomas Wisniewski, who's been a longtime investor. I still miss the Accelerator and I still miss pitch, but tell us what you're up to these days. I do. Sorry, I had to put that little dig in there.
All right. What am I up to these days? Well, I launched Newark Venture Partners, as you're aware, but maybe not everyone else, about 6 years ago. So it's a seed stage venture capital firm that's based in Newark, New Jersey. And in the first fund was largely backed by corporations and family offices and other high net worth people that had some connection to Newark, New Jersey. And the idea was part of a larger one driven by kind of a vision of Don Katz. Don is the founder and chairman of Audible. So Audible is a division of Amazon, the audiobook company. They're based in Newark. And his thought was, I want to build a tech ecosystem here where we need some venture capital and that the attention that's going to draw. How do we do that? And I joined him, loved the idea and kind of built it out, and then went back to the corporations and got them to do the funding for the initial $44 million seed fund. We're on fund 2. We've been investing out of that for about 2 years. We are B2B software focused, right? So within that, we are opportunistic, but at any one time, we are researching and digging into several themes that will probably do 2/3 or 3/4 of our investments will probably fit into one of those themes, the remainder being completely opportunistic. So the themes that we're actively working on now, digital health, or we continue to work on digital health, and this is software IT layer for providers of healthcare. And payers in the healthcare world. Part of our model is the alignment of some of these themes against some of the major corporations and others that are LPs in the fund. So in this case,
Oops, you froze. Uh-oh.
Relationship with them that allows us to kind of mine their ideas, get deal flow from them, and bring deals to them and get things checked out before we even invest, and then get agreement from the LPs that they're going to be interested in at least having conversations. And in some cases that builds into a commercial relationship, which is great. So we like that kind of a collaborative model. So that's digital health, also supply chain and logistics. And within that world, B2B commerce, the commerce piece that connects the companies, supply chain being goods moving, but it's also information. It's also how things are sold with particular specialty in the B2B commerce piece. And one model there that I'm particularly interested in and investing in is B2B marketplaces. This is marketplaces for stuff sold between businesses. So we happen to be an investor, say, in a marketplace for the parts for heavy equipment. So if your forklift breaks, where do you go, kind of a thing, right? And there's a logic behind how screwed up the industry is, and these guys are using a marketplace model to kind of sort that out. It's an example. So actively looking at those. In addition, we do fintech, especially embedded fintech. We've been looking outside the US for the first time there. So we've been looking at LATAM for seeing some interesting things there and getting more comfortable. We have yet to make an investment in Latin America, but we see that kind of coming in the next, within this year, probably at least one. In addition to that, we do occasionally do deals in our investments in audio through the advantage of having Audible, the largest audiobook platform. Most recently, we were investors in a Pod Sites, a company called Pod Sites, did analytics for pods advertising, basically short form advertising on podcasts, and that was bought by Spotify earlier in this year. It was announced. I guess that's sort of an example of one of the more recent things that's happened. What else? So we have a space in Newark, which during Fund 1 we used actively for an accelerator. We still have companies there. We offer that for free to any company we've invested in and other companies we like. We invest everywhere, even though we're based in Newark and we have a Newark mission per se, but we invest in companies everywhere. Some portion of those will choose to settle down in Newark, and that's great. And we'll look to help them lay down roots and tap into all of the companies that we have there and the real estate folks that we're close with, and build the ecosystem there. Let me just wrap it up by saying, so we are B2B software. We look to invest 1 to 3 million at the seed stage. We target getting 10% ownership, and then we try and use follow-on to keep that at least for the next round or so. And we do about, I would say, probably somewhere in the order of 10 to 14 investments a year. That seems to be about the pace at which we're at. We're a team of about 10.
Thank you, Thomas. And I will also mention that Thomas has had quite a few exits. And when you're working with VCs, you also want to ask how many exits they've had. So let's have everybody introduce themselves. Chip, do you want to go first? I'm just going through the gallery.
Certainly. I'm Trip Braden. I'm currently working on a number of projects in the area of HR tech. And I'm going to it next week, Healthcare Capital Summit in Columbus, Ohio. So I'm going to do that next week for our client. So that's kind of where I'm at. Thanks, Bonnie.
Eric Becker.
Thanks, Bonnie. This is the first time here, but I know Trip and I know Bonnie from Angel Span on our meetings here, but I'm Eric Becker. I'm the CEO of Millimatch, which is in human capital risk management. And basically, our technology addresses in dealing with attrition in employees in corporations. And it does some other specialty things. We're in the field of healthcare, education, manufacturing. And thank you very much for inviting me, Bonnie.
Oh, sure. Alec, sorry.
No problem. Good morning. Actually, founder and CEO of a company from Fund 1 at MVP. So I missed the labs as well. The lab was a wonderful program for us. My co-founder and I are 20+ year veterans of the construction industry, and we launched construction tech in the very fragmented space of the US construction market, tools built for the field, so out on the job site. And we're just hitting a pretty cool milestone of a million ARR, and really excited about where we're still going with the construction space. It's a pretty underdeveloped field, and our co-founder and I work out of the Newark office when we do go to office, but we're working pretty remote for these days.
Oh, thank you. Sean. Oh.
Hey, I'll be quick because I'm in a so thank you for having me. Oh, can you hear me?
Yeah, it was breaking up a little bit.
Yeah, I apologize. Yeah, I'll be quick and okay. So my name's Sean. I'm co-located between the UK and Florida. I'm a venture capital scout. We help both founders and investors. founders pre-seed, seed, kind of de-risk and to access trusted capital. I also provide funding strategies to startups and scale-ups. Obviously, help investors make strategic investments in founders, developing future next-gen tech. My verticals are kind of modeling, simulation, and training, defense tech. I started my career working for a services-enabled veteran-owned business. So I heavily kind of lean on defense. Fintech, game development, infrastructure, medical, healthcare innovations. I have a ton of those innovations, and recently kind of transportation, travel, and logistics, prop tech. Thank you.
Oh, thank you. Ian.
Thanks, Bonnie. So I'm Ian Garmes in Toronto. I'm the Canadian sales and marketing rep for the Virtual Film School. And we teach people online how to make monetizable short videos.
Oh,
Thank you.
Ann Kearney.
Hi, my name's Anne. I'm creating an experience where we connect tourists with locals to have a super authentic experience. And I'm so excited that you all are here.
Oh, we're happy to have you here too. Derek. Oh, you're muted, Derek. Oh, we'll come back to you. Jim, who's also muted at the moment. I know some people work out of workspaces and they can't always talk, and so they just listen. All right, Allie, you're up.
All right. Yeah, so I am a former executive of Dun & Bradstreet, located in the Newark metro area. I know about Newark Venture Partners because I've had a couple of friends funded by Newark Venture Partners, and also
and Dun & Bradstreet is an LP in Fund One.
Yes, no, absolutely, and of course have a good friend over at FF Ventures as well. I am currently COO of Adept ID. I moved over from AWS, and what we do is we actually basically have machine learning solutions that power the applications and training organizations and employers who are looking to improve their ability to identify talent in the marketplace. So everything from hidden talent to diversity and inclusion and so forth. So a lot of people think of us as either opportunity tech, up tech, or work tech, HR tech. There's a lot of terms for it. But certainly we're looking to use our technology to improve kind of the situation for non-traditional workers in the market, as well as reduce social inequity in the marketplace by identifying hidden talent. Thank you.
Oh, thank you. I'm trying to get the link in. So questions, who has questions? There's always questions. And I know that Trip is going to have the first one because he always has a question. Oh, but you're muted, Trip.
Was hoping to hear a little bit from Thomas about how he's looking at things now with the economy shifting. What's he doing to take advantage of that?
Good question.
With the economy shifting, you're saying?
Yeah, a little bit of what's going on. I'm in the Midwest, so we're seeing a little bit of a slowdown in investments right now. Wondering what you're seeing out where you are and how you're managing that.
Yeah. So I think that if you were either a founder raising or even aware of things going on, or an investor during 2021, you would have really felt like the industry was kind of hot relative to what it had been, and it kind of continued to heat up through the end of the year. What did that result in? It felt like valuations had jumped pretty considerably during that period. Maybe not all in 2021, but that was certainly where it began to really feel it. So we found more money chasing deal valuations going up. So from a founder's perspective, not a bad environment. A more difficult one for a VC that wants to make sure that they're investing at the in the proper way. I think that as a result of the public markets kind of going through a gyration and trending down, a correction of some kind, that the wealth effect, probably has everyone feels a bit poorer when all their public equities have dropped, and especially when the public equities of these companies that formerly VC-backed companies who IPO'd, many of them are now trading dramatically below where their IPO was, and that has an effect at decreasing the enthusiasm at the upper reaches of venture capital. So you heard about deals, people going back and renegotiating them after them being set. And I think I think that during that period, my observation was during the 2021 period was there were deals getting done, and it did seem like there was a lot of capital around, but for the most part, it was chasing a small number of deals, a smaller number of what were considered to be higher quality deals. And people would define that in different ways. So that I don't know that it was that much easier for, a first-time founder trying to raise capital, going through that, that process of trying to get all the pieces together to be ready, to just find money that people were jumping at them so much as if you were in a sector that people liked, if you had some connection to the industry, maybe some, some prior experience as a founder, and you had either super hot sector or good traction, it tended to attract a lot of attention, right? And once one VC was interested, it would attract others, and you'd get this sort of, feeding frenzy is the wrong word, but that idea that they would be attracted into nodes. And I saw deals just get priced up beyond where I would be willing to, and seed deals, that I would have seen going in maybe the 10s or 20s for a pre-money valuation, ending up 60, 70, 100 for hot deals, and lots of stuff in there. So I think conservatively, I felt like the valuations basically kind of doubled. Things that seed deals that I would have been seeing basically below 10, or were going between 10 and 20, and some reaching higher than that, and deals that had been going in that, teen range were now in the 25, 30, and occasionally higher. So what's happened since then is one thing, look, the amount of venture capital that was available did not suddenly change between Q4 and Q1. There's dry powders there. The time horizons for venture capital are, 4 to 5 year investment periods, 10-year life of a fund. So by your very nature as a venture capitalist, you can be longer term. You can have a longer term view because your money's not going to get pulled out. You have a long time to try and perform. So there's a tendency of people to sort of stick with stuff. So that hasn't changed. I think that everyone probably took their foot off the accelerator a bit. Maybe became a little wary of the deal maybe that they were chasing at that point. But my sense is that deals are continuing to get done. I looked at the financing stats for Q1, and they're a little contradictory based on where you look, but it looked as if that deal volume was down, but not crazily so, and dollars were down, but I think a little bit more, which indicated to me that some of the deals at the upper end, I'm talking about seed, by the way, they're not the upper market. And I think that the other effect there is that public markets leading some of the change in perception, leading to kind of growth stage pre-IPO, depression of valuations. By the time you get down to seed, it's relatively insulated from that, right? Because the companies have to go through 2 or 3 more stages before they're going to even be close to that. So I think that we begin with being a little bit more insulated in kind of our world of this, but it has had an effect. But I've seen sort of a reset, something that might have been, people be asking 25 million for a pre-money, and it's back down into the teens, that kind of an effect. People not getting deals done, it just taking longer, or getting to an outcome where they don't get a lead, and they're looking for alternative ways to to get finance. People looking for higher, more traction, more proof points in order to move forward. That's been my observations, at least.
Thank you. That's great.
I have a question, since I was wondering if you at all recommending that founders at the seed stage might want to ask for a little bit more, considering these times, and just to have a little more dry powder on hand, just in case, because it might be harder to get to the Series A.
Yeah, I mean, in a way, that's a kind of a loaded question, right? Because I think that there's a tricky question, because there's can you get financed, right, at some level, right? And that's the hardest part, right? Trying to get to that. And then if you happen to make it to that level, right, then this question is, all right, should I push a little farther, and take another, if I'm raising, 1.5, push to see if I could raise to 2, or hey, if I'm in the really great position of I'm at 1.5 and people are offering me more, should I take it, right? Kind of a thing. I'm always in favor of at the margin expanding those rounds. I think I've never met an entrepreneur, a seed stage entrepreneur, that took a little bit more money and regretted it. Never. It has never happened, right? I can imagine if you were like at the B stage and someone wanted to give you $100 million and you couldn't spend it all, you might regret that. But at this stage, it almost always makes sense. People are willing to offer you money at the margin, not doubling the size of the round, but at the margin, taking a bit more will make sense all the time, I think. That said, those are just for the practical reasons of things always take longer, and it's great to have a bit more of a cushion, and it'll give you a little bit more confidence in making hires and all that. All that said is, in these periods of uncertainty where you're not sure where the market is going, whether it's, whether we're heading into a recession and therefore the VC market may get depressed or with valuations and with money available for some period of time, having a little extra capital, thinking a little bit more defensively is important, right? I mean, as a founder, you can't afford to be acting defensively all the time, right? Because that doesn't lead to these kind of outcomes and trajectories that we want in venture capital. But at the same time, you're thinking about, that's what I want, having some, focusing a little bit more on the questions like, if this was the last capital I ever received, what would I do, right? Could I survive? What would I need to do in order to make that work? Is there a way, I don't want to be at break even necessarily, because I really would like to continue to invest and grow, but what would it take to get there? Because that's a defensive position where you're not reliant on having to raise money. So I put that, with Bonnie, your comment, in that bucket of, in these uncertain times, that you got to think a little bit more defensively. The plan B or C, right, is warranted.
Thank you. Next question. Tommy got here a little bit late. Tommy, do you want to introduce yourself before we move to the next question?
Hi, Bonnie. Thanks for having me. Hi, Thomas. I am an ML practitioner, machine learning. So I've just graduated with a master's in data science. I did a little bit of finance work to start out. I did a lot of community work with the women's entrepreneurship community. And I've been working on startups for like over 10 years. I'm really right now focused on my current startup, which is sort of using ML to empower people with regard to their dating. And I will be raising probably a pre-seed round soon. So very relevant. And I thank you for all your insights, Thomas. And I hope to have I see a lot of familiar people in the room as usual, so I won't bore you, but I will ask some questions.
No, feel free to ask a question.
Okay, sounds good.
Actually, I'll ask you a question. So you say AI applied to dating, you're talking about kind of better algorithms for matching people?
That, but we have a very distinct philosophy that we believe is resilient to the way the dating market has been progressing. So the dating industry has been, for at least the past 10 years, I think, mostly controlled by a couple of monopolies. And as a result, there is very little innovation up until this year, where I think they're all sort of seeing the writing on the wall. AI is getting much more ubiquitous. By AI, I mean machine learning models, et cetera, that are open source. But the philosophy of most of the dating apps is to keep their ML a secret. It's their proprietary software, et cetera. So they are resilient to my model, to my philosophy, which is to make the ML accessible to people. And because I'm from the ML industry, I understand that the way, say, OkCupid, which is the most data science heavy dating app out there, which is now owned by a monopoly, the way they do their data science is really old. Current ML practitioners do not do their data science that way. We have much better methods. We have methods that protect against bias. We have all of these things at our disposal that are not being shown to the public. And part of this is that people are afraid only the really large companies like Google are making their ML sort of accessible. And so everyone's sort of leaving it to them to figure it out. But there are a lot of small things that we can do that make a huge difference in terms of getting rid of. So for young men, anecdotally, they're viewing like every third profile is either an escort or somebody who wants the young man to follow them on social media. So this is a lot of people's first introduction to the dating world as a young man. And for women, it's probably worse. So a lot of unwanted contact and I'm forgetting the exact number, but it's like upwards to 80% of young women are getting unwanted contacts, such as stalking, swears, pictures, whatnot. So they're starting to try and fix this problem. For instance, Tinder is, but they're not fixing the philosophy behind it that makes this this happen. So we're in a particularly great niche where we can use the latest technology to solve a lot of these real world problems. We can do it throughout our entire mission. We don't need to sort of take small, like incremental little steps towards it, because our model is going to be different than that closed model. So I've gone on a long time about this, but
no, fascinating. Is there a question that you would have coming out of that directly?
Well, so obviously this is a little more complicated than a typical MVP. We're not just changing the UX, which is a lot of dating apps that are coming out right now. They just have a small change on the user interface side. So, understandably, people are excited about this. They think the pre-seed round will go well, even during the recession. But, I do have more complicated, it's a little more complicated planning my product in the future. So, because it's going to be so different than the dating app, and it is a little bit more complicated doing the MVP. I mean, I can do all the ML myself. I do have a strategy where I'm working with a lot of people who are super part-time versus like 3 dedicated co-founders or whatever. So there's that, and I think I can sell that approach. My friends are really talented. There's no reason why they need to be like super full-time right now just to build an MVP. But yeah, so it's slower than I think I'd like to go sometimes. But yeah, a lot of moving pieces.
Okay, good. I don't know that much about the dating industry other than from observation. My own singlehood kind of predated all of that. I always thought it would have been nice to have been out there single during an era of it. Maybe that's just grass is always greener.
Half of the people on my team are married and have never experienced the dating apps, and they are like, it's like encountering the madhouse. Like everybody who's used dating apps, almost everybody, unless they find their partner sort of in the beginning, a lot of the dating apps will give you a lot of good matches. And if you find your partner in that period of time, you're happy, right? But everyone else is miserable. It's horrible. You do not want to do it.
I can't go there on that, but my observation was, and I had a close friend who was innovating in the dating app world, and this is back in the late 90s and early 2000s. So I think it's kind of cool as a person more broadly in the industry to look at dating apps and just see this is one of those that's gone through, like, I don't know how many generations, right? Because I every time, you know, a new dating app comes out and becomes the new thing, I always think, like, damn, like, did we really need another one? Was there really a reason for that? And that innovation just keeps coming in a sense, right? Trying something different. Now, maybe some of it's just a new one, a new name, but I remember when Tinder came out, you know, well, you can say whatever you want about it now, but it was an innovation when it came out, right? That did a very different way to solve a set of problems that tend to create friction in dating. And the fact that you're on here saying you're thinking about reinventing it again, you know, makes me smile. It strikes me it's one of those that's been on the web forever, some of the earliest apps, and it's still, you know, being recreated and redone. And I guess it's recession proof, right?
It is. It performs very
everyone
well.
wants relationships. One wants a relationship.
It's even pandemic proof, which I wouldn't have expected, but it is.
Nice meeting you.
Nice to meet you.
So Alex, you've been there nodding and smiling, maybe even laughing. I want to know why.
Only because I've experienced what Tom said he hasn't experienced, and Tom and I know each other well enough to have some good conversations around a glass of whiskey or two. But yes, to Tommy's point, the dating app world is politely chaos. Having like marched through it twice deliberately and exited it twice deliberately. And, you know, set it down. So yes, reinventing itself, more than welcome. It is a holy crap show.
But I also know, like, I don't know, I would say maybe the third of the people I know who are married, they found
I've been in
multiple
weddings.
A third.
Multiple weddings.
Third of the people, you know, weddings I've gone to recently, people who got married. You know, and they're always a little sheepish to say, like, yeah, we met on Tinder, you know, but it's, you know, for what it's worth, it's not just a fringe activity, and it's not just people meeting on the most conservative, relationship-oriented dating sites. But
40% of people on Tinder want a long-term relationship. Like 12% get one.
And Bonnie, the fun of this is, again, having known Tom now long enough, he can speak at depth about a lot more than I have ever imagined. And he's been tremendous for us in our industry, but here we are talking about a dating app. But to Tommy, your point, my friends, I think 3/4 of the ones that have met and married through a dating app ended up meeting on Tinder. They started somewhere else, they wound up back on Tinder, and they didn't tell anybody about it until after they were married because they were ashamed of the stigma that went with that. So anyway, the sidebar over, but that's why I was nodding and laughing, Bonnie. I've been there, lived it. And
I don't know if maybe it's so in San Francisco this is the first time I used a dating app when I moved from New York to San Francisco, and I was working my startup a lot. I wasn't going out, so I used the dating app, and they all view it as normal there. So I think it only has, like, for a brief period of time, it had that reputation, but a lot of people I know are just on all the dating apps. Like I'm, you know, like, so I'm solving my own problem. So I'm still single, and I've used all the dating apps, and I have accounts on all of them, and some perform better than the others. Here's something interesting though, for Bonnie perhaps, which is that, you know, I've talked to investors before about things that's going on, and normally the conversation's like 50-50. But if I'm talking to an investor who is single, they talk far more than I do. So that's an interesting dynamic. Yeah.
I feel like it's a subject.
I think if I don't jump in, I'm not going to get a leg in edgeways. So my name's Derek Thomas. I think it's quite fascinating the way that this dating app has been thought about. I think one of the things that we ought to consider is the pandemic that we've just come out of and how attitudes towards online dating have changed. A lot of people relied on dating apps and dating services because they couldn't physically go out and meet people. And what that's done is it's reshaped the way that we interact with each other, and the reliance on technology for what were kind of niche-y, kind of embarrassing type of services is now just ordinary. It's normal. It's common. So, in as far, personally speaking, in as far as the value of dating services is concerned, I think there's a whole generation out there that knows nothing else but dating online and meeting people online. And so therefore it's a huge, huge potential market that will continue growing. The interesting thing for me, coming from an AI background, is the machine learning aspect that you've integrated in that. And I would love to hear a little bit more about that if time allows. But I think that's where the magic really is, the differentiator, the thing that differentiates your app from other apps in the market. So that's my 2 pennies.
I love to talk about it. What is your background?
I wanted to ask Derek, I know you didn't have time to introduce yourself earlier. You had to jump onto the call, but do you want to introduce
I'm really
yourself?
sorry. Yeah, sure. I had a call come through, so I had to jump off for a little while. So I'm based in London, but I've started a mobile money, which is e-money service for Africa. We're expecting our banking license in the next 3 months, 90 days. It's been approved. It's going to presentation with the regulator, and once we have a banking license, we're going to start offering mobile money which is youth oriented. So for youth, for women, and for youth businesses and services. So our idea is that we can capture somebody at university or college and right through their working career and until they retire through financial products, which start at saving and putting their money on the wallet rather than using a bank. And then we offer them services like insurance. And as they change through their careers and their needs change, we'll partner with them and anticipate what their needs are. So that's the project I'm working on right now. We're pre-seed. What we need is about $500,000 to get this show on the road. But that's what I'm working on right now. My broader career has been in management consulting. I was head of IT advisory for KPMG in the Middle East, and I've worked for just about every industry you can think of between the UK.
We try to keep the introduction. Oh, I'm sorry, I didn't mean to interrupt, but we try to keep the introductions short so that if people have questions. Any other questions before we go back to the
yeah, Derek, do you have a question?
Yeah, I just wanted to find out a little bit more about the ML side, machine learning side on the app. What's the differentiator?
Does anybody have a question for Thomas before we go back to the dating app? Anyone?
I think what would be interesting, I mean, I think, Tom, you sort of hit on it, and I don't mean to pick the brain of the person that has advised me through some time here, but, you know, in this current moment of investing, I feel like there is this want for investors to gather, validate, and I know we had some discussions even at the end of last year about some of this. And is that a trend because of you know, the potential recession and the current finances or situation in the world, or was that a trend that was naturally happening? Is that a natural thing of investors, or is maybe the economy influencing that?
So when you say gather here, you mean like sort of strength in numbers, a bit of a lemming effect? Is that
yeah, that you know, there's always been FOMO. Everybody talks about FOMO, and I'm a big paradigm breaker of I tend to not love that concept and drive investors to FOMO. But but it works. So all the investors that say they love that we don't do that, I'm like, well, but you all fall prey to it. So, but having said that and pulling back from it, saying, okay, well, last year it felt like there were a lot of investors that were looking for co-deals, multiple investors coming in together. Is that, maybe traveling in packs or herds, result of the economy?
So yes and no, right? I think the no is probably the beginning of it, which is that, if you look across venture capital, generally speaking, especially at the seed stage, but even through A and mostly the rest of it, all deals are shared, right? So it's very uncommon for someone to come in and say, I'm going to take the whole round, right? Strategic sometimes, occasionally you get a VC doing it, but it's unusual. It happens. There are firms that like to do it more when things get competitive. Maybe that happens. So there's always that going on. And there tends to be, firms tend to pair up with each other, right? When you find another investor that you like to work with and that you trust, and that your thinking is aligned on stuff, and not just one, but some group of them, you tend to do a bunch of deals together that way. So you're used to kind of hunting in packs. Right? I got this deal, I'm going to share it with him. I'm going to get an opinion from, Sarah or Jim, who's my friend, and I've done deals before. So that collaboration aspect of it within a tighter group is very common. And then there's collaboration, with circle beyond that, where I know you, maybe you haven't done a deal together, but I'll work with you. And it's, why do it? Well, there's a sharing of risk, right? Across the deal. There's the gaining of additional insight, right? There's manpower, in terms of I can't be on every board. So you tend to see that sharing piece of it. That's just normal, right? When I think what you're referring to is that depending upon what sector you're in, and you kind of in the sector you are, right? And we've talked about this. You're construction tech, right? And we could call it different things, but it's about software that is going to create innovation and efficiencies in the construction yard, right? Place where there isn't a lot of tech. Starts with, in a way, with that. You are that. You're not going to break out of that unless you change what you are, and that has appeal to some set of investors or not, right? And that kind of changes with the wind, and trends that are going on within one of those, right? If it's not like on the list for a large number of investors, right? If we're not sure that there's a group of people, co-investors that are out there, and I, as a seed stage investor, am thinking about, all right, I'm just part of the route that this company is going to take. I need to, even if I believe in this company and think they're doing well, I need to assess whether there's going to be another investor who's going to come along and want to do the Series A, right? Because I, as a seed investor, I'll participate in Series A, but I'm not going to lead it, right? You always have to think about who's upstream. So you definitely, within sectors like you're in, and it's to some extent everywhere, people are thinking about, all right, how sure am I that, one, is this company going to work out? And how sure am I that there's going to be additional investors who are going to want to look at this category? And if you think about it, right, there's a fundamental trade-off. You really should be going in a sense where other people aren't, right? And looking at deals and finding things innovative, because those are the cutting edge people. But at the same time, if you go too early, you also risk, we call it kind of financing risk, upstream financing risk. So you do tend to see when there's some uncertainty about the category or whatever, people are more sensitive to that. I think we saw that, as we were advising you and you were out, fundraising. I think that, and you're in the industry you're in. You can't really change. You're not going to change that per se. But in our discussions, some people look at construction and they say, how big could this possibly become here, right? And this is a question everyone asks. But some people look at your space and go, I don't know. Could you create $1 billion company here, considering you've got these other big guys sitting here? And when you get a couple different points of that of uncertainty there, and then the environment becomes a little bit more uncertain, right? Then you're right. You tend to see people going, I'd like to be someone else. In fact, that's what we talked about. Hey, let's go find a co-investor, right? I need, given I'm not a construction investor, I would love to invest, but I need somebody on board who I feel like is an expert, right? So I'm explicitly saying that to you, but that does happen. So it's about sharing risk. It's about sharing deals. It's also about looking for added validation that comes from additional investors. I would say the other thing that goes with that is that the most common thing you see when you go through one of these periods where the market's slowing down, downshifting, because of perceived environment, is people just wait. They're like, well, I like it, but I want to see a little more. So that's what you'll start hearing, like, yeah, that's great, but I just want to see a little bit more traction, right? Because one, that's just I'm not comfortable investing now. I kind of want to wait. But two, naturally, but more traction points are more proof. So it kind of fits together. I'm not quite ready. I want to slow down. More traction would be better. So then you start seeing that things where it used to be, hey, if I had $1 million ARR, I was right in the zone for a Series A, right? That was, I would say 2 years ago, that was a mantra that worked. You could have a slightly higher valuation, slightly higher growth rate, maybe, and be less than, an ARR, or need a bit more because of some other thing. But that benchmark has definitely moved. You don't hear that one anymore. Now, it's also a function of the fact that entrepreneurs, coming out of YC and other places have moved the bar up. So now I got to think, instead of a Series A for $1 million run rate company, at 13 million or 15 million pre, the deal that's out there is one that's at 25. So the other thing you're seeing in terms of people wanting more traction is the fact that the valuations have gone up too. So I'm naturally going to be looking for, something that's a little farther along. General stuff. So, any questions about that, guys? Would anyone disagree?
I have a follow-on question to that. I'll be quick because I'm in a crowded space. So what's your view on crowdfunding deals? So for example, I've had some kind of pushback from that from some investors. Some really like it because obviously, you're rolling up all the funders into the cap table. So, what's your, from your perspective and from your verticals, what's your view on crowdfunding as a source of financing for startups?
Yeah, and I guess I would separate kind of crowdfunding of investors from kind of crowdfunding of an Indiegogo campaign or one of those. Important to kind of understand, because I think that in that kind of older school, more traditional one where I put out a campaign, I pre-sell my product, I get people interested in either giving me money or pre-buying things. That's awesome. That's revenue is the best source of financing. How about revenue before you even have a product, right? That's fantastic. It's not new if you think about it. It seems like it's new there, but that's like what real estate did, right? We're going to build this great building. It's going to look amazing. If you want an apartment in that building, you got to give me a 10% deposit now or something else. And again, so I financed my construction based on people willing to give me money now. So that tends to work mostly for physical products or for something that people, I don't know, particularly care about. I think you're talking about the other stuff, which is investors buying equity or getting a safe and heading down that route, right, to ownership and backing. I'm not a fan. I think as a co-investor with it, I don't think there's nothing wrong with it. Money's money. If that's the money that you can get, that's great. There are, just having sheer numbers of people on a cap table, the more there are, depending upon the structure, the more complicated it gets, right? So if you're a follow-on investor, it can make getting the next few financings done, it does have a lot to do with structure though, small things, right? Like, are they individually on the cap table, or are they on the cap table through an entity, right? do I need to deal with all those individual investors, or can I just deal with, you know, the lead or whoever's got the, you know, whoever's got the micro fund or the special purpose vehicle, right? That's on there. The other risk isn't just numbers, and this happens with angels too, right? Angels would be maybe the next step up, right? And not that people who are doing crowdfunding are angels, but more traditional angels or people tend to be writing larger checks, 25 grand, something like that. And again, it's the same effect. VCs aren't always happy when a cap table is full of, you know, individuals who are on the cap table individually, you know, like that. And scale creates that problem and complexity. The other thing is, if you have a bad actor or just an annoying actor on your cap table, right? Could be the VC too. Sometimes they're not great, or the strategic, or the something else. But if you have a bad actor on your cap table, it can create all sorts of pain and suffering, right? So, if you're talking to other professional investors, VCs, the likelihood you're going to run into someone like that is much lower, because as soon as I get a bad reputation in the industry, I'm not going to get deal flow, right? If I'm known as an asshole, and I'm professional, I want to be in this longer term. So it doesn't work perfectly, but you tend to see that. I can also, if I know that you've been successful, I also know that you as a fellow investor kind of know the rules of the game, right? Know that your money may never come back, right? And that you're going to lose it more times than that. If you add more and more people to the cap table, it also creates this risk, because I don't know, maybe somebody who you brought in is litigious, right? And the deal didn't work out and they suddenly decide to sue. And they can. In the US, you can sue for anything. So that's the other risk that's out there. It doesn't always happen, but it can. Famously, before I started the fund, I was an angel investor out of my own family office, and I started out doing a lot of that through New York Angels. And this is a good kind of a funny story in its own right, and then leads back to this. Pinterest came through. It wasn't Pinterest at the time; it was called Tote. And I remember the presentation from the guy, and I thought, this guy is amazing, but that's never going to work, right? And so I passed on it. I think 2 New York Angels went into it. The valuation was like $2 million or something like this, $3 million, very, very low. And they went ahead and they failed once, had to come back, get more money, failed again. And then third time was the charm. And essentially what happened was the interface they were using became the whole product. And Pinterest was born, this idea of all the little pins, and that took off. So 1 or 2 angels, made an incredible investment there, 1500x or something crazy. However, a company that came in right around the same time that company came through decided to sue Pinterest and sue the investors, saying that somehow their IP got stolen, right? So this isn't another investor, isn't exactly what you're talking about, but that lawsuit is still going on. That's still going on. And that meeting was back in like 2008. And it's totally frivolous, but it points out, like, the legal bills from it, for one of my colleagues who was one of the investors, were over $1 million, right? So the point is, like, one, it's a funny story, that I passed on something that was so, that could have been such a great investment. And 2, that it has this thing, but it just sort of points out that knowing who your investors are and having, knowing that they're accredited, not in the sense of the definition, but in the, I know what I'm getting myself into here, right? Is important.
Following up on the last point, so Tommy had mentioned that she has lots of collaborators on her project. So I've heard of something called the lost founder syndrome. So when a company gets funded, or when some other progress is made, all of a sudden somebody who had been involved with the project earlier and maybe left for some reason suddenly reappears and gets involved in litigation. Have you ever seen any situations like that, or is it something to worry about or not? Or
No, I don't worry about it. I mean, I've certainly seen it happen, the very famous ones with Facebook and such. It doesn't tend to happen unless something like this, like Pinterest happens or Facebook happens, where there's so much money at stake that you can keep pressing and maybe people will give you money just to go away, right? I think. So no, I'm not worried. I don't get worried about that piece of things. I would step back and say, I'm more worried about kind of the dynamics among the founders and whether is that founding team complete. If a founder left recently, why did they leave? Founders leave all the time. It's not a big deal, but you want to understand the dynamic that led to that, right? And then, what's the dynamic among that existing group? What's the combined skill set that they have? What's the next senior person they're going to need to bring in, either as a founder or as someone else? That dynamic I do care a lot about. And when there's someone who's left, I think about it. And if they're circling and maybe gonna come back, I don't see that very often. Or if there's somebody who's, hey, they're on the team page, as Tommy may have some of these people on there. You need to be honest and say they're working part-time. What I'll immediately say is, all right, that's great. It's great. Who here is going to join full-time, as a result of the funding? Because if you're not joining full-time as a result of the funding, then you're not the team, right? Ultimately. So that's one of those things people get very sensitive to is, don't call these people part of your team and full-time if they aren't, because that's just the reality, but that's fine. And I really want to know that you either have a more complete team there today, or what that team's going to be. So, as a result of this funding, I'm going to be able to bring Jane, and Bob on board to be my, sales guy, my lead dev. I can't have him yet. Well, that's fine, right? So it's that team dynamic I do care about, but less so about the dangers of someone coming back. There's dangers I have noticed in boyfriend, girlfriend.
Oh, yeah.
Bad news. I've invested in two of those where I didn't know ahead of time. It was there. They had a falling out, and you're
Tinder
screwed.
And Bumble.
Husband and wife? No, that's okay. That's worked. I mean, I don't know that any of them been a spectacular success that I can think of, but there wasn't a blow up because of some, if anything, sort of much more dedicated to each other, and can spell each other in times of need. But boyfriend, girlfriend, that's tough.
Oh, I know a husband-wife situation. Home Depot was founded by a husband and wife, and they got divorced, and she ended up founding Lowe's.
Mm-hmm. I didn't know that. That's great.
Yep.
Isn't
that fabulous?
I did not know that. It's fantastic.
Yeah, Eventbrite is a husband and wife as well.
Obviously,
another one.
Obviously, once it's successful, right? And then there's the normal kind of midlife. Hey, maybe we're not good together long term. Not worried about that part. It's more something that could upset the period between me investing and the next round, right?
Yeah. Cisco was husband and wife,
Yes.
as I recall. It didn't end up all that well, but
They ended up divorcing.
right. But she was like the primary driver. The wife was the primary force, as I recall.
So who have we not heard from? Who has a question or who has a?
Oh, Anne has a question.
A quick question. So I'm really doing the grassroots, building strong, building with excellence, just really slow growth. What do you think about like micro investment, or should we just continue just slow growing with ourselves?
Got to give me a little bit more context about what business you're in and what's been happening over the kind of, what do you mean by slow growth?
Yeah, for sure. We're running this program. It's called Lunch with a Local. So we'll take tourists that are coming into DC out for lunch, kind of like a local bestie experience. So they'll come hang out just like the local hangouts places, somewhere they wouldn't get on like this huge tour. And so like there really isn't a lot of fees that we need because they're paying for their own lunch. We're paying for our own lunch. The service fee is just what the client is paying. So like they'll pay us, a certain amount of money just to take them out. But like a little bit of money would be helpful for like website, things like that. Does that make sense?
Yeah. Okay. Yeah. I mean, if money is available, right, then that's my guess is it would have to be as part of a plan that you're going to be getting, larger much more quickly, and that ultimately this thing could become venture backable, right? And that's a pretty high bar. And since there are lots and lots of good businesses that may not ever reach that kind of level, you can create a great business and have it not be a doubling and tripling every year kind of number, which is what VCs want to see, and have it be great. Given the sector that you're in, as an investor, if you were asking me, or if I was advising you about, potentially raising capital, my biggest concern would be that there have been many companies before you that have tried at least similar things, right? And that you're going to need to contend with at least a perception that this category has been attempted and either been done, right? So what's unique about what you're doing? Why you? Why now? Why here? There's always answers to those questions, but I think that my sense is that if you were going to say an angel group like New York Angels, which looks at just about everything, or pick another one where it's representative of the, you would have a hard time probably attracting traditional angel money because of that, unless you were showing some incredible growth, right? Something that would make people look at it again and say, wow, okay, I thought this was sort of done or been done and either worked or didn't, but you need to show something. So I think that if the business is growing organically at a level that's sustainable, that's fantastic. If it isn't, and that wouldn't be surprising because you need capital in order to expand, and for new models, margins and revenue, sometimes come later. Then you're on a journey to try and find an investor who would be a fit to what you're doing. And my suggestion would be it's going to be a minority of people that either understand that segment, have a passion for it, are strategic, that has a benefit of being associated with it. That would be my, or there are other ways. There are obviously accelerators and programs that are out there. As a female entrepreneur, there's other resources available to you, people who would really like to see more female founders succeed. Those also could be, kind of potential sources and not just solve some funding, but also provide some support and advice.
Definitely. I'm in a program with GW right now, and they provide support and mentorship. But I was just curious. And so thank you so much for your feedback. Like, you all are amazing, and I appreciate you all.
All right. Very welcome.
I also wanted to add that I recently met an investor who does micro investing, but he doesn't take percentages. He sets up a profit sharing, and I'm going to have him speak at a breakfast soon. So Derek has his hand raised.
Yes, a quick one. I just wanted to find out what your take is on founder versus co-founder, solo founder versus co-founder from a risk management perspective or appetite perspective.
Yeah. So the general wisdom is that solo founders is difficult to finance, right? And there is truth in that, and then there's obviously part where it isn't true. So it's sort of a yes and no. Why? Well, sometimes seeing a solo founder and someone doing this, it may indicate that they don't yet have one of the key pieces that is going to be necessary in order to get this off the ground. So they're the tech guy or gal, but they don't have the business piece. Those two pieces being kind of in a tech founder, it's being kind of the most important to have present in some fashion. Sometimes they're together, sometimes they're in other mixes, but often it needs more. So that's one. So it's like no one person is probably going to be powerful enough in a sense to do that. It also could indicate that this is a person who's not very good at attracting other people and bringing them in, right? Obviously, it's a little different if I'm a solo founder, but I've got a crew of 5 people working for me full time for free. And my perception then would be as an investor, wow, because this person's obviously good at attracting talent and doing that. You know, and there's maybe a different issue there. So the look of a solo founder is one where you're questioning, or you're wondering, like, are all the pieces there at this point in time? What's the next piece going to be? Often it happens that we have a business founder, right, who has the idea, really gets the industry, but doesn't have a tech co-founder there, so is left trying to figure out how to build stuff using consultants or outside things or stuff on the fly, and that's very difficult, right? That very quickly that founder would need to be able to bring tech talent, at least the lead dev, in, you know, you're not going to want to invest as most investors aren't going to want to invest until you saw that combination there already, or on the verge. As soon as we get financed, here's the guy or gal, they're going to join. All right, proto team is there, you know. And then I'd step back and look for the next piece. All right, you got business, you got tech. Do they have sales in there? Right? Do they have product? What are the other pieces there as this thing expands? So, you know, more usually means more, right? So if you have 3 talented co-founders who've known each other for a while, you know, all things equal, there's a lot there. There's more there, right? Doesn't mean it's going to be better than a solo founder, but there's more opportunity for you to have a you know, a strong team right away.
Thank you for that.
Yeah. Other questions?
Yeah, Tommy has a question. Sorry, I was muted.
Hey.
By the way, Tommy, how are you, Tommy? I'm being Tom. I'm sort of wondering.
I'm that is the phonetic spelling of my Japanese name.
Ah, okay.
Yes, which is
Wonderful.
Tamiko. Ko means sort of girl in Japanese, so you'll see it with a lot of Japanese names. Ko, or like ka for guys, things like that. Yeah. So,
okay.
Yeah. So actually, also you can add the word chan if you ever have a family member who's Japanese, and that means love. So like my grandmother will sometimes call me like Tommy-chan, or my dad maybe. So
you've learned something new every day. I did not know.
Yeah, and it was actually, I was working, that was my job at a family office when I first encountered startup and tech. I was fortunate enough to meet some super connectors who introduced me to everyone in New York tech at the time right away. So that was my introduction. But I was at a family office, and my boss was like, "What is that? What is that, Tomiko?" And I said, "Yeah." So he said, "You're Tommy." And I said, "Okay." That is technically my name. But yeah, it helps people to pronounce it properly because the spelling is a little different. So my question is that, you know, I grew up in a town where pretty much like 90% of the people were in finance, right? And so I think your background is also public equities a little bit, and then now private. And so everyone was in banking in the town that I grew up in. I worked for a small amount of time for a small family office who did public equities. And what's surprising to me, I guess, because intuitively, you know, I'm used to public equities where your product marketing plans are like at least 6 months, you know, versus in startup where it's like it's hard to get a plan for 6 months. So, you know, when I first encountered startup and I got really involved in women's entrepreneurship and the community, you know, my plans were like naturally 2 years long, right? And I would end up like talking to people about the next 4 months, but you know, my plan was definitely like much longer than that. And I found that like with public equities, you know, it's a little bit different in terms of how people, I think, group together. There was someone who asked a question about investing together, et cetera. So yeah, obviously there are a lot of relationships in public equities. A lot of it is about that. It's a big world. So it's easier to work with people that you know. But I found that there was like less of a rumor mill, maybe not on the in the trading side, but like when you're talking about investing, like we would invest in sort of like smaller mid-cap companies as well, and take a majority ownership. So there was just more of a focus on like the actual plan versus sort of like, you know, like, does this person have what it takes? Do they have grit? Like, you know, and I found that at least from my perception, it was a little bit easier to get like a diversity of investments because it was product focused. It wasn't so much like, you know, does this person have like social proof or whatever?
So your question is sort of why then, or what perspective
well,
I
I just
have on that?
You know, after Theranos and things like that, it's not really hurting VCs because they have like such like great returns on other companies that do well. It's not hurting them that they have such an interpretive job yet. But I just feel like, you know, why is there a difference in the culture? Is that difference in the culture really there? How is it hurting VCs? How is it helping them?
Yeah, so I would what I would say is the following. You know, yeah, so I haven't done much in the public equity world for quite some time. My first job out of school was for an investment bank, and I did tech there. I did go to business school, so I got a sort of a generalist background. I have worked also in, you know, sort of in big private equity. You know, to me, all of what we're doing here in venture capital is probably private equity. But typically, when you talk about that, you're talking about larger companies, and there's sort of the mid-market of private equity, and maybe somewhere below that. You know, you could talk about venture capital, at least at the seed stage. And,
right.
You know,
Yeah, you're probably past the point where, you know, it's sort of right.
No. So I'll take it as a continuum, right? It doesn't always work that way, but you know, what's different about public markets versus sort of seed? One, the companies are much larger, right? Much more farther along. Businesses are much more established. There's much more there, right?
Mm-hmm.
And the there is represented by the track record. The past couple of years tells you a lot about what the company is today. The data is actually available because there really is data. The financials actually mean something because they're data points from a functioning, you know, business, a functioning, you know, box of all these different parts. And in the public markets, particularly because of the filing rules, information is available, you know, more widely. That's sort of the goal of public markets, to have that kind of information symmetry. As a result, farther along, information being, you know, much more useful, I think, and representative of the company, and then widely available, there's much more to focus on there, right? And any one person in that organization isn't going to have, you know, an outside goal, except maybe the CEO or someone, you know, leadership within the thing. So I think as a result, you just have other things to look at that are more powerful. But then you take that back to seed stage, right, where you know, people have a plan, and you could talk about how long that plan is or whatever, and we could get into kind of timing of those things, but they have a plan. I would hope it would be one that has a lot of focus on, hey, what have I done the last X months or whatever? What am I going to do in this next period? Yeah, and then I have a vision for where I'm going to be. One thing I know about that plan is it's never going to be right. So it's going to be so incredibly wrong because it's impossible to predict these things. So when I look at that plan, really what I'm looking for is, how are they thinking about it? You know, does this have the potential to do that, have that big outcome? What would be, so I can't judge the facts in there because we know collectively that it's going to work out some different way. The past doesn't tell me very much because honestly, that's the whole point, right? You're moving in this direction where things are growing or becoming more concrete over time. So a lot of those things you have in the public market just aren't available, right? So what you do know is, you know, the founders, the people who are there, that is who you're backing, because they may change their pivot their company, decide to do something different. And that's what you want, right? Because that's how good companies come about. They look for product market fit. So how do you do that other than trying to, you know, really understand the people involved and trying to understand the qualities that are important. Now, you'll hear all sorts of different things about what those qualities are, you know, stick-to-itiveness and grit and these other things. And, you know, some people talk about having, you know, more vision or having this skill or that skill, but that's a difference in maybe what I think is true. What's certainly true for everybody is we believe that there are some set of skills that are really important to success, right? And that's something you can look at and be sure, not sure, but that's going to be what's mostly driving this entity towards success, is that, you know, full stop. Obviously, you need to be in an industry that makes sense, that's big enough and juicy enough. Obviously, you need to have a business idea that fits. But I think what I heard from you is that a lot of why we look at the world differently, right, and share our perspectives is we're making much more of a not a deduction through the math, but a, you know, induction in trying to understand something that doesn't exist yet, and trying to read the tea leaves on where it would go. That's my sense as to kind of why, one way of thinking about why those worlds are different.
Right,
Now,
right. Yeah, I think, I mean, like, obviously what I'm saying is very qualitative and not scientific, but I guess my impression is that sort of in the startup world, in that world, sometimes people with a lot of grit just happen to not be able to get into certain rooms. And so they're not able to demonstrate their grit. Rooms meaning like rooms, or even like potentially, you know, a lane where you might get to sell your product. And so like looking for even like a little bit of traction even within their background or their geography or whatever is diverse about them is probably a good thing. And I know people are focused on that more. But I just found that, like, at least, you know, in conversation with the public equity people that I knew, you know, they're more likely to sort of see that spark and be like, okay, I imagine you being able to function in this room or in this industry, and sort of push you along. Whereas startup is a little bit more like paranoid about like, oh, well, let me see you actually functioning in all of these rooms before this is such a risky investment, etc. So then you get these anomalies like the Theranos, who just is able to function in every room, but there's no spark, like they don't actually have a thing, right? So I'm hoping that culture, it's getting like it's changing, it's getting better.
Yeah, I think it's you know, I don't want to poo-poo the need for greater diversity. In fact, it's something that's very close to us. We run a very diverse firm. Our team is minority white guys, and our more than half of our portfolio has a founder of color or a female founder in it. So it is something we believe in and just do naturally. That said, raising money is hard, very hard, right? I've done it for companies, I've done it for myself, I do it now as a fund. There are a lot of things that you need to get right in order to make that work. Most of why people can't raise or struggle with stuff is something's missing, something's not quite there, right? It isn't that they don't like you or that you won't be getting a chance or anything. It's one of those elements isn't quite there, and it is a really tough puzzle. So most of the time the answer is more you. And I don't mean to put it back on you, but to me it's like I either need to communicate what I'm doing differently, or I need to find a different set of people to talk to, or I need to change something that's within my control. Do it. Now, the challenge is if you come from outside the industry, you don't know what you don't know. And everyone's got a bit of this, but one would imagine that if you come from an underrepresented background, you're going to know a little less, right? And therefore, you're going to come with maybe an incomplete package, but also maybe not the coaching or the wherewithal to kind of figure out what those pieces are, being coached into it. What I find is, you know, most VCs, most people I know, they're good people. They don't have outward biases on, you know, on color of skin or women or men or that sort of thing. They are very sensitive to trying to judge whether something is, you know, really good or not, or is worth investing in. And because this is us reading tea leaves and there's so many different variables going on, the answer as to what you need to do in order to get financed or how to make your company better is just not clear. I'll have an opinion, another investor will have a different opinion. So my sense is most of the time it's something that's within your control, that, you know, if you could get some advice or figure it out, that you can do it, that it is not a lack of somebody, you know, not wanting to see you or not wanting to be in a room together.
Here's a funny story of sort of illustrating how I think about it, which is, you know, minorities are not necessarily, you know, the usual suspects. Like, so for instance, in the Valley, when I first moved there, people told me that these programmers that would often be founders or do very well in startups would have like very little social experience. They've been coding like their whole lives, right? And so they would send these guys to classes on how to have dinner, how to be social, how to like survive like as an adult. So they recognize that, hey, if we want someone who's super talented, they're gonna have like a sort of minority experience in that, you know, they're not gonna be like the majority. They're not gonna have spent all of their time going to dinners in high school. They were coding. And so they created something to equalize that and teach, like sort of train them up so that they can function.
Yeah, and I think that those are great examples. My guess is that happened in a very, very minority of the time, right? Because I don't know, but mostly those people either figured it out themselves enough to develop. Look, everybody comes with like things they're really good at and stuff they're not, right? And over your life, you know, if you're successful, you find ways of, you know, leveraging that stuff you're good at and filling in some of your gaps, or grabbing other people to work with you who kind of mesh well. You know, and yeah, people can get better at that. You're right. That example, that's a very mainstream example, right? Not even a minority example, right? Where you find someone who's, they got deficits, great, super talented programmer, but that to be good at that, it tends to attract a particular kind of personality, not all the time, but most of the time. And often that person is not going to have, say, the sales skill set, right? Or maybe even the extrovert, you know, able to provide vision. Not every time, but often that's the case. So you're right. There are those things. So I think that there is a lot, obviously, we can all do to try to be more aware of, like, you know, inherent biases we may have or we aren't even aware of, right, in talking to people and that sort of thing. But I think that it's, as a founder going into this, it's much more important and more empowering to try and figure out, like, what are all those things that I need, right? How do I sift through all this information people are telling me? And then, all right, if I need to be more social, then all right, let me go figure that out, right? You know, or I've tried this and that hasn't worked. Let me try something else. Or, you know, and not get caught up in unempowering things like, oh, I just couldn't get into the room. People don't like women or just whatever, and that's the reason why this isn't happening. Yeah, there's some of that, but more often than not, and certainly more empowering, is to think about the things that you can actually change or do.
Yeah, I agree. I mean, obviously, working in the women's community and just in general, I've had a lot of conversations about this, and most people are focused on practical things they can do to improve their lives and their understanding of where they're going and things like that. So yeah, I think that's on point for sure. And then sometimes, you know, they sometimes people just repress the fact that these things are going on, and they just need to talk about it to come up with a solution that's good, you know. So yeah, but it's interesting, and just like looking at the way different industries have pluses and minuses is interesting to me. So I really like how, you know, in public equities they're like really focused on like that positive spark, and you know, obviously it might be because they have more numbers, so they have the freedom to do that. But yeah, it's interesting how things change.
Cool.
Oh, Bonnie, you're muted.
I wanted to say, I always do that. I always forget. Ian posted a comment in the chat about Ivy. And that
About
kind
Ivy
of lines up
League, yeah. About the
Yes.
Ivy League and
Yeah, that there's an evident preference for attendees of Ivy League schools in funding. I mean, the evidence is kind of around us, and it's still evident today, as far as I know.
meaning
Mel.
you come. It helps to come from it helps for funding to come from a named school.
Yes. Yes.
I would disagree, yeah, because you are looking for, you're looking for data points that will quickly try and tell you, the quality of someone, right? And it's kind of like screening resumes. You're looking really quickly through stuff. So yeah, data points like that, they do mean something. It can, anyone who puts too much weight in any one of them obviously is going to get burned, right? But Harvard and Stanford and all these places. I mean, when I was working at a consulting firm and we were growing and I was trying to build a recruiting function. I thought, like, why are we focused on these schools? Why are they this? Well, they've done a really thorough job of aggregating a lot of very smart people, right? And if we think about the machine that they run there to take huge bodies of really talented people and even more. Now, it doesn't mean everybody coming out of there is, but honestly, that's the reason why why companies go there. It's because they've done this job, done a lot of the job for them. Everyone there is going to have passed some sort of smartness or whatever thing, and you're reading through that. So those things do have meaning. That said, I would never make these people didn't come from schools I know, so I'm not going to talk to them. I would also, you do look at schools, but you look at backgrounds. What companies did they work for? What did they do there, right? And that is informative of someone's abilities and their success. It isn't everything, but it is something. And then obviously you spend a lot of time just listening to them, listening to the founders and where they are today. Forget about their background. Who are they today, and does it have credibility and all that.
Encouraging.
Not to scare anybody, but I went Ivy, and I was a science major, and of course I was in classes with all these people who were going to medical school. Can I tell you how much cheating I saw? I'm like, I'm not going to, and I was like, not going to any of them. These guys when they hit medical school, a lot of cheating went on. I was not one of the cheaters. I did well on my own, and yeah, it was Ivy. So heads up, people.
Yeah, it happens everywhere.
I can just say that look, getting VC funding is not a right; it's a privilege. So if you're in an environment, this is my personal opinion. If you're in an environment that's limiting and requires you to be part of the tribe, the Ivy League tribe, then for goodness sake, go on an online course and get an Ivy League diploma over 9 weeks and join the pack. It shouldn't be a limiting factor. I think what, like Tommy was saying before, sometimes we overemphasize or over-exaggerate how limiting some of these factors are, and if you're really determined, I think you can invite yourself into the room.
Sure,
That's my take.
Yeah, and like I would say that you are where you are, right? You are. I can't change what school I went to X years ago, and it wasn't terribly impressive. I went to Clark University. I didn't go to Ivy League school. I did manage to finagle my way into Dartmouth for business school, so that kind of helped me there a bit. But I got it through hook and crook. But anyway, that is what it is. It's kind of like also you are where you are with the traction you've got. You are where you are in a sense with the team that you've got today, right? That's sort of a set of facts about where you can figure out the right way to market your team and to market your background, or to fill in a perceived deficit that you might have in your team or whatever. But you kind of start with those things. It's what you do with it, right? It's how you fill in the other things, right? That are there. And I'm especially with something like traction, which tends to be where you are. How far advanced are you? When I say traction, I mean not just numbers, but product market fit and all that. The first thing I want to know is just, what do you do? right? If I don't know what it is your company, your venture is trying to do, the what of what it is, and if I don't quickly get kind of the why of like what's the value that it provides, right? And where you are from a traction standpoint, right? And why you're raising the money, sort of quick, similar. All the other stuff's not going to matter, right? And I found, right? You could be a great team, you could have all the other things, right? But one of the really difficult problems in venture capital and just anywhere is that you've got to take somebody from 0 to 60 miles an hour in 2 minutes, right? Kind of the elevator pitch or the 5-minute pitch or whatever. There's a lot there, right? You've been working on this thing. These businesses are complicated. You've got to figure out a way to get me from 0, I know nothing. Maybe you even talked to me before, but I'm still going to have to be reminded of it. There's still going to be that 0 to 60 kind of effect, and that's challenging, right? And often what you see, most common mistakes you see with founders is, not everybody is good at pitching and presenting, right? It doesn't come naturally to all of us. Didn't come naturally to me, but you can learn it, is the thing. It is a learned art, and one that you can get better, everyone can get better at. And so, not surprisingly, it's a sales activity, and it's powerful for all sorts of things: attracting the team, attracting investors, attracting clients. So it's worth spending time on learning. But if you think about kind of what most investors, almost most entrepreneurs, especially earlier ones, struggle with, is telling their story in a way that I'm going to be able to get, the what of what it is. We are a SaaS, a SaaS platform that these kind of companies use for doing this. It generates this kind of value. We're in market with this many clients and this level of revenue. If you can't kind of summarize that for me in a way that I can kind of grasp onto, all the other stuff that comes with your pitch, I'm not going to be able to get, right? You're going to lose me there. Or you're going to start talking about how important the team is, but I'm not going to have a basis to understand it, right? And I'm not going to have a clear sense of what business you're in, or what's most important in it. So therefore, knowing that your team worked at Google and went to Harvard or whatever isn't going to matter to me, right? So most of the time, I would say the struggles that people have with fundraising, or the things they could do at, you are where you are, the things that you could do at that point in time in order to improve your chances, are things that are within your control. Pitching just happens to be one that I'm passionate about and I think a lot about, and is usually where, what distinguishes a good meeting I have with a founder from, one that doesn't feel like it's going to be going anywhere. Were they able to quickly kind of tell me what they're doing, understand how to explain it in a way that shows me that what's unique about it and that it has some value. Because if I don't get past that, the likelihood I'm going to be spending a lot more time with that person is pretty low, right? We got to look at 100 things as investors, or we do, and we end up investing in one. That's sort of the math that ends up working out in venture capital. If I'm wrong by that, it's either a half a company or it's 2, but it's that kind of thing. So you're as an investor, you're constantly looking at stuff and trying to make real quick decisions on, hey, all right, I talked to this person at or read their email. Do I want to open up their attachment? Does it seem like it's enough worthwhile to open it up? Oh, I've read their thing, open their attachment. Does it make enough sense for me to schedule half an hour with them, right? So this given that pattern of VCs needing to look at all these different things to find stuff that they like, being able to communicate effectively and in a way that you're going to sort of draw people into the next step is super important, and is something that you can get better at. Is I guess the point I'm making.
I work with a lot of entrepreneurs, and I think part of the problem is, they all go by the pitch deck, the template, and they think that that's the order in which everything has to be presented, and they don't realize that you have to lead with your strengths, with your superpower. They'll just go, I'm like, why is this buried on slide 8 when this is the story? And Yes, it's a disservice as much as it is a help. Wouldn't you agree?
People taking a template and trying to use that straight away.
Yep.
Yeah, I mean, it's this. You're a practitioner, so I'm not going to be telling you something you don't know, but structure is real important, I think, insofar as you're trying to tell a pretty complicated story, the 0 to 60 in a short period of time. So giving people information, in a kind of concise way that takes them through it like this does help, in most cases, get you through that 0 to 60, so where I understand enough to know whether I want to spend more time on it. However, you're right. If you're overly wedded to that structure, right, or are making changes in it that aren't based on some particular need, right, then you're right. It can throw things off. For instance, some people just take one thing. Where should I put the team slide? Should the team slide go up front right away? Should it go toward the back? Bunch of different factors there in that one. Part of it would be what Bonnie says. Is it a trump card team? Are you you were going to be absolutely objective about it. Are you the A team here? Do you have people on your team that rolled out of companies similar to this, have had past exits, have really the backgrounds, both business and tech, that would make this superstar, right? Most people aren't that, right? So most people leading purely with that up front may or may not make a lot of sense. However, relatively speaking, if that's a strength, then you probably do want to move it up. You have to keep it in a sequence that makes sense. I still have to know, before you showed me the team, what the hell you do, right? So that I can reflect on why the team, is good. But I think structure is good. I think starting with a structure of some kind is helpful for most entrepreneurs. But as you're going through that, I often see what you see, Bonnie, which is like, well, wait a minute, why are you putting this up front when something else belongs there, right? And that's that's part of the art, I guess, of presenting, rather than the structural science.
Somebody else wanted. I know we're going way over time, and I don't know if you have to run, Thomas. Does anybody have any last question? Oh, Ian does.
I would love help with my pitch. Do you have resources to check out, courses, books, etc.?
Love help with your pitch. So what I would say about that is that the problem is not resources. Actually, there's too many. If you look up perfect pitch deck, right, you're going to find like, and it's almost, it's like too much. So what I would say is, do that though. Read through a few of them. This is the perfect pitch, and here's why, and then start with that. Right, pick one of those and see if you feel like it improves, what you've got today. After you've done that and gotten, the right way to do pitch, improving your pitch is, one, study something or get feedback, like going to look at what defines a good pitch, adapting what you're doing and trying it out on people, right? And then based on that feedback, looping back again and being willing to do that a lot, right? That's the process. If you're talking about like resources like that, pick a format, try and make it work, get advice from people about whether it's going to. Ultimately, you're going to feel like people are giving you a lot of advice that's contradictory. That will happen naturally, right? What I would say to you is ultimately it's going to be your responsibility to figure out what advice to take and what not, and how to, to modify what you're doing. But I think often entrepreneurs get caught up with one pitch deck saying you put this up front and one saying you should really have that. If you think about one level below why somebody is saying you should have this, especially in feedback, right? You really need to have your financials in here in some particular place. why are they saying that? And why did this other person say, no, don't worry about that, put that later? It often has to do with something that's sort of a step below, that you're looking to establish where you are. If I don't see the financials, I don't know that you're a seed stage, pre-seed, or whatever. So yeah, financials are great to have in there, but what that person was grasping at was, if I don't see those, I don't know where you are, right? So, that's the concept you're looking for. That's the reason why they gave that comment. So it's about looking at that advice as you get into it, trying to go kind of a level deeper and understand what the rationale for that was. Otherwise, you're going to get very confused at all these different, or you should feel natural. It will be natural if you get a little confused. And the way to unconfuse yourself is to kind of look below a little bit and then go through this recursive process of trying things out.
Thank you so much. So generous.
Remember, it's a template. It's a template. It's not carved in stone. Ian, did you have a?
Oh,
you
yes.
had a
Question. Tom, you mentioned you have an interest now in Latin America startups. Could you just say a little bit about what kind of companies you've been investing in Latin America?
Well, we haven't invested yet in there, but it would be within one of our themes, right? So we do a fair amount in supply chain, logistics, and fintech, and there's just a lot of that going on down in LATAM. And it's usually some function of, hey, I'm going to get started in this country, and then I'm going to create something more pan LATAM, because each country generally aren't big enough to create kind of their own standalone startups. So it's that kind of thing. So one we're looking at right now has to do with sort of fintech associated with residential solar. Residential solar is taking off in some of these markets. It's kind of played out here a lot already, but utility prices are high down in this country they're starting with. They're getting even higher. There are companies that are already that are there already doing the installations, but financing is a huge barrier there. So it's an example of one where it's about embedded the financing option right into the offer, to this. And there's a logistic aspect to the equipment and all the others. There was another business we were looking at that was about supplying medium-sized retailers, like people who would otherwise have been trying to use Costco and places like that to restock their shelves or get the inputs from the restaurant or whatever. Things like Cisco don't exist down there, right? So it was an idea of sort of a logistics play to create a company that was going to be more efficient doing that kind of commerce.
Okay, thanks. That's helpful. Thank you.
Yeah, and why LATAM? I mean, I think it's. I have not invested much outside the United States. Occasionally, Israeli company coming over or European company coming over. I think that some of those interesting things that are happening in some of these areas that we're looking at are outside the country. It's become a little easier to do that. Other people have kind of trailblazed ahead of, me certainly. There's also strategically, I think like LATAM is a good place to play, given all the uncertainty in China and what's going on in Russia and Europe and this whole supply chain onshoring piece. It seems to me that creating, quote unquote onshore, but in Latin America is going to become more popular. Although we're not investing into that just yet, that's gonna make, I think, LATAM much more interesting to everybody in the U.S. markets coming forward.
Yeah,
Do you head down to Miami for that? I just met a telecoms founder. I'm in Miami right now, and I'm curious if you get a lot of traffic or meetings through Miami.
We do, yeah. I mean, Miami's actually there's a secondary city effect that we like to mine, which is that lots of great deals, interesting stuff come out of places that aren't New York or the Valley, or people who haven't gotten to one most places. So we're a little different in our approach. Traditionally in venture capital, your deal flow comes from your network, right? And we still get a lot of that. Other VCs bring you stuff, founders referring other founders coming back, other connectors, Bonnie sending me something, I meet you at this event, those kind of things. But we started a while ago doing a lot of outbound, right? So the same kind of thing that your sales development rep would be doing to try and find a client, potential client. Well, here's a name of a person I want to find in this kind of company. And they would start using LinkedIn and other databases to try and find people who fit that profile. We've got a couple of people on our team that do that for founders and trying to find them before they reach out, or find them before we find them through some kind of a network or get out there. And often that leads us to, Chicago and to Miami or lots of other places. And I think given COVID, people are a lot more accepting of virtual, right? So I think it's even easier now to invest in founders that are going to be based in other places. So yes.
Fun.
It helps if you speak. It helps if you speak Spanish, though, when you're doing this. I don't speak Spanish, So think if we're gonna get big into LATAM, we're gonna have to have someone on the team who's fluent. It feels like you need that when you're down in Miami too, right? It's like everyone just assumes you speak Spanish.
Right. Yeah. Well, a lot of them speak English, but
of course they do. I just meant like there's you come from other places. I don't have a problem with it. Just like there's so much going on in Spanish, right?
Yeah. Well, it's a different beast down here in Miami for sure. But I was just curious because I've met a lot of telecom from LATAM here, but I don't know about these other industries that are coming up. That's very interesting. So thanks for bringing that up and asking that, Ian, as well.
Okay. Well, good.
I know we've gone way over time, and thank you for generously giving us this extra time, Thomas. And work too. Thank you, Christine. We appreciate it. I'm not even going to ask if there are any more questions. So I know the holiday weekend is coming up. I hope you all have a wonderful holiday weekend and enjoy the North Shore, Thomas. And thank you all for being here. And we'll be back in 2 weeks with the next investor. And we're always happy to have Thomas back. He always has a lot to add. And thank you so much. And have a great day, everybody. And a good holiday.
Thanks.
Bye, everybody.
Thank you.
Thanks.
Thank you.